The calculation of an employee's gross pay is the first step for payroll processing. In this video, I'll show you how to calculate the gross pay for salaried and hourly employees and discuss commission pay and piece rate work. Let's start first with salaried workers. Salaried workers are employees employed in highly technical, qualification-driven positions within a company, and they're classified as being exempt from the Fair Labor Standards regulations. Accountants, lawyers, and executives, those are the type of salaried positions, typically administrative, that are considered salaried positions. And again, they are typically exempt from overtime regulations of the FLSA. But there's a threshold to being an employee who's exempt from the FLSA regulations. The minimum salary for exempt employees was $684 per week since 2019, or $35,568 a year. That changed as of July 1st, 2024 to $844 per week, and January 1st, 2025 to $1,128 per week, with the final rule of the U.S. Department of Labor, DOL. However, this final rule was overturned in one of several challenges and is currently being appealed by the Department of Labor. Our textbook uses the $844 per week salary, but the legal minimum salary for exempt employees still stands at $684 per week. In California, it's a little simpler because exempt workers must be paid a salary that is at least twice the state's minimum wage. That means salaried workers as of January 1st, 2025 must earn at least $68,640 per year, or $1,320 per week. There is an exception, though, to the general rule that exempt employees are not subject to the FLSA overtime rules. Some salaried workers can be subject to overtime requirements by law. For instance, if the employee is in a non-managerial position, the employee would still receive overtime. These type of employees are called salaried non-exempt employees. To obtain the hourly amount for a salaried worker, we divide the annual salary by the number of hours per year. Here's an example. A salaried non-exempt employee earns $2,000 per week and has a standard 45-hour work week. The reference to the 45-hour work week means that the salaried employee only gets overtime when they work more than the 45 hours per week. And non-exempt means that this employee is subject to overtime. To calculate the hourly rate on weekly wages for a salaried non-exempt employee, we divide the weekly wages by the number of hours in this salaried employee's standard work week. Some employees may have 40-hour work weeks, some have 37.5 hours. This salaried employee has 45 hours, so we divide 2,000 by 45 and find $44.44 per hour as the hourly rate. Let's look at the second calculation. In this case, the annual salary is $104,000. So in this case, you would take the annual salary divided by the number of weeks per year, 52, and divided by the standard number of hours per week, in this case 45, and also arrive at $44.44 per hour. So it really just depends on what your starting point is, either the weekly, bi-weekly, semi-monthly, or annual salary. In the third calculation, we're calculating what the gross pay would be if the salaried non-exempt employee who has a standard 45-hour work week works 50 hours and earns a weekly salary of $2,000. We would first take the base pay of $2,000 per week for 45 hours and calculate the hourly rate like we did in the first calculation. The hourly rate is $44.44 per hour. And when a salaried non-exempt employee works overtime, they receive an overtime premium, which is 50% more than their regular hourly rate, which means that we multiply $44.44 by 50% and add it to the regular hourly rate, or you can multiply the regular rate by 1.5, which gives you the pay for every overtime hour. This employee worked 5 hours overtime, and to get the overtime pay, we multiply the 5 hours by $66.66, which is the regular rate of $44.44 plus the overtime premium for a total overtime pay of $333.33. We add the overtime pay to the regular pay for a total gross wage of $2,333.33. Let's look at this example. In this case, we have an exempt employee who earns $104,000 per year and has a standard work week of 40 hours. Some salaried employees are eligible for overtime, but this employee is not because it tells us that this employee is exempt, meaning exempt from the overtime provisions of the Fair Labor Standards Act. To calculate the hourly rate on an annual salary, we would take the annual salary of $104,000 divided by 52 weeks and divided by 40 hours. Why 40 hours? Well, we were told this employee has a standard 40-hour work week. The result is $50 per hour. What would happen if this employee works 60 hours a week or 80 hours per week? What if the employee works 35 hours per week? Well, if the employee works more than the standard hour work week, there is no extra pay, regardless of how many hours. There is no extra pay. If the employee works less than the 40-hour work week, then there is typically no reduction in pay. But take that as a general rule. There are some states that allow employers to reduce the pay if the employee works less than the standard work week. In accounting, it is common to work extra hours during busy season or during month close. It is expected that you work extra hours during that time. However, outside those times, you have the flexibility to leave early and work less than 40 hours per week. If you find that you're always working lots of extra hours per week, it's perhaps time to hire additional people on your team or figure out how to streamline some of the processes so that the work is reduced. What about hourly workers? How are they different from salaried workers? Well, hourly workers are paid for any hours or fraction of the hours they work and receive overtime for hours worked that are more than 40 hours, according to the Fair Labor Standards Act. Most people work 8 hours, but companies may offer different work shifts and workday length, such as 4 10-hour shifts or 5 8-hour shifts. It can also depend on what kind of company you work for. Sometimes it takes a long time to set up machines in a manufacturing company. If it takes 2 hours to set up certain machines, you're only going to get 6 hours of actual production out of that shift in terms of full productive hours. So sometimes it really makes sense to just extend the hours per shift to perhaps 10 hours so that you can get more production out of it. State regulations may require the company with 10-hour shifts to file an election to pay no overtime. The main reason for filing the election should not be the avoidance of overtime pay, but rather the economic benefit of setup times. An employee may also be working more than one job classification, especially in small businesses that happens regularly. So that means that the hourly rate that the employee receives may vary. And here's an example. Evan works as a clerk in the Human Resources Department for a company for which she receives an hourly rate of $15.65. But she also occasionally fills in as a receptionist, and then she receives $1.50 more. That's called an hour differential. In this example, we're told the dollar amount of the differential, but sometimes it's expressed as a percentage. So this week, Evan worked 35 hours in the Human Resource Department, and 5 hours as a receptionist at the front desk. What is Evan's gross pay for the week? We will multiply 35 hours by $15.65 for $547.75, and we multiply the 5 hours by $17.15 because she gets $1.50 more per hour as a receptionist for $85.75. The total gross pay is $633.50. Some employees earn commissions, sometimes on top of their regular salary, sometimes that's the only pay they receive. Commission always relates to a company's sales revenue, and commission is based on how much somebody sells. In addition, the employee must be materially involved in the sale of the product, but does not participate in manufacturing the product. Commission-based employees may be exempt or non-exempt, so both can be the case. And that depends on whether the employee is an inside salesperson or an outside salesperson. An inside salesperson means that the customer comes to the business and then the employee must receive at least the minimum wage during each pay period. An outside salesperson is a person who visits the customer's place of business. They're exempt from the Fair Labor Standards Act minimum wage provision. So here's an example. We have Whitney, an outside salesperson. We know that the FLSA doesn't apply. The person makes 8% commission on all sales. She had $4,650 in sales in one pay period. What's her gross pay? And does her employer need to contribute towards her pay to meet the FLSA standards? So that answer is already no, because we learned for outside salespeople, the FLSA does not apply. So here the answer is no. Take the number of sales that the person made times 8%, and that's $372. Not that great of a sale week. But let's look at Byron. He's an inside salesperson. He earns an annual salary of $132,600 plus 5% commission on total sales that he makes during the pay period. So during a biweekly period, he had $92,820 in sales. How much is he getting paid? Well, first of all, we need to calculate his biweekly pay based on his annual salary. I come up with $5,100, and then we'll calculate the commission of $92,820 in sales times 5% and come up with $4,641 for a total pay of $9,741. What about piece rate work? It is one of the oldest pay methods, and under this pay methodology, the employee is paid based on their output. That means the employer receives compensation for units manufactured or actions performed. It could be based on number of units manufactured, but it could also be based on how many cakes you decorate or how many social media posts you generate for a company. It just must be quantifiable output for piece rate work. In this case, the employees are non-exempt and are subject to FLSA minimum hourly rates. That is why it's important to compute the employee's hourly wage for the period to ensure that they receive at least the minimum wage. So that's important. Let's look at two examples. John and Sarah both work in Nebraska, and they actually work together. John is a piece rate worker who receives $15 per completed piece of work, and Sarah gets the same amount. During a 40-hour work week, he completes 35 pieces, and so his pay would be $525 because 35 pieces times $15 is $525. We'll calculate the hourly wage by dividing 525 by 40 hours, and we come up with $13.13. In Nebraska, the rate is $12 per hour, so we're okay. He receives enough based on the piece rate pay to be above Nebraska's minimum wage. What about Sarah? She only made 30 pieces. So her pay is $450. And when we divide $450 by 40 hours, we arrive at $11.25. In this case, the pay is not enough. Sarah has to make at least $12 per hour, which is the minimum wage rate in Nebraska per hour. And so her employer would have to actually pay her more. He would have to pay $480, which is 40 times $12 per hour. Let's summarize what we learned. The most common pay types are salaried and hourly. I'm not quite sure how it is in other countries, but certainly here in the US, salaries and hourly are the most common ones. Hourly employees and salaried non-exempt employees receive overtime pay. Employees can receive 2 different hourly rates for different work. Remember the person that worked in HR and worked as a receptionist. So you can have 2 different hourly rates. 2 additional pay types are commission and piece rate work. Inside salespeople are subject to the FLSA, whereas outside salespeople are not subject to the FLSA.